Good morning from London. I'm Kriti Gupta alongside Lizzy Burden and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Ukraine has agreed to a critical minerals deal with the United States, according to people familiar, in a move that eases recent tensions and allows joint development of natural resources. Meanwhile, U.S. growth concerns seep into the market after consumer confidence dropped by the most in almost 4 years, sending bond yields sharply lower in the overnight session. And Nvidia due to report fourth quarter earnings with a focus on its AI build-out and DeepSeek impact. Lizzy.
Well, we've got markets getting back on their feet after yesterday's wobble, Kriti. Or was it a wobble? The 10-year Treasury yield back up to 433.27. The dollar gaining again, and on the flip side, euro dollar down to 104. Futures stateside pointing higher ahead of the Nvidia earnings, and European futures pointing to a stonking start. The countdown to the opening trade starts right now.
A lot to digest. We've got one eye on what's going on in Washington, D.C. We've got another eye on earnings, got a slew of them here in Europe. We've got a lot going on in terms of what we've got in the next 24 hours, though. But let's maybe look backwards before we look forwards. Tom, we started to see this yesterday as well. This economic resilience story out of America getting a wobble, as Lizzy called it.
We wouldn't think we would be talking about potential fragility in the US economy just a couple of weeks ago, potentially a couple of months ago, because that is the narrative, as you say now, that it's starting to build. It's certainly not consensus yet, but there's a slew of economic data, and you had that, the most recent consumer sentiment survey in the US, reminding us that there is caution now amongst US consumers particularly, but on a host of data points, there are question marks now about this US economy, and that's why you saw a significant move into Treasuries yesterday, yields falling about 11 basis points. Shock horror if you're talking about tariffs and you're imposing tariffs, plus everything else in terms of deportation of migrants. That has an impact on the consumer, that has an impact on sentiment, and that is what is starting to come through. Is it going to change, though, the Fed's response? Markets are starting to price in additional cuts.
It was interesting because you had Scott Bessent kind of fueling it by saying that 10-year yields should naturally drop as a result of Trump's policy. And I know we always talk about Donald Trump seeing the stock market as a kind of real-time referendum on his presidency, but Bessent then said that Trump cares about the 10-year yield as well. So kind of wondering if Trump is looking at the 10-year more than the S&P.
And at the same time, they had a budget blueprint passed in the House yesterday. They're still talking about potential tax cuts down the pipe. We'll see how that reflects in the sentiment as well. Let's talk about the earnings picture. That's the other piece that we have to talk about. We've got Nvidia later today. We've got a BP Capital Markets later today. I'm sure you'll nerd out on Nvidia a little bit later. We're also getting Stellantis earnings this morning as well. A gigantic drop when it comes to the operating margin. A pretty kind of deep sell-off that we're seeing in Lexus Stellantis, but it feels like Nvidia is the growth catalyst perhaps for the next couple of days, weeks, months, maybe?
Nvidia is certainly the story that either makes or breaks. I mean, this is the view of many out there, makes or breaks the markets, at least in the short term. But we can meditate on what's happening with Stellantis. It's not an idiosyncratic story, of course. We know the challenges within the auto industry, the maker of Jeep and Fiat, of course. The operating margin for the full year coming in at 5.5%, miserable compared to the estimates of close to 13%. This is a company, the stock is up year to date by about 7% or thereabouts. But the clear challenge is there in terms of the portfolio of businesses. By the way, when you're looking for details around the CEO change at the top at Stellantis and what that can mean for the strategy. There's concern about a lack of clarity, maybe, at least that's the view from some analysts, around the strategy going forward for this automaker. Again, this is not idiosyncratic to the maker of Jeep. It is a challenge across this industry, and tariffs will only make that more complicated.
And we're going to get that, of course, after the bell in the U.S. In the meantime, I said BP is also one we're going to be watching specifically in the European session. But commodities largely in focus, not just in the oil space, but in the broader geopolitical space as well, right, Lizzy?
Yeah, because Ukraine's said to have this deal with the US on terms for minerals. The cabinet expected to recommend today that deal be signed. We don't know the figure yet, although it has been said that it won't be the $500 billion that the US originally wanted. Remember, Zelensky said that the value of US aid in the war was not more like $70 billion. So let's see where they settle there. Interesting to see as well, Keir Starmer, the UK Prime Minister, announcing defence spending, a target date for that, funding it with aid money. So echoing the Donald Trump style, but because it's just reallocated funds, not seeing much of a bond move.
Is going to be crucial as well because, of course, we're talking about this. You mentioned that $500 billion figure. Bloomberg Analysis, our very own Javier Blossom on our opinion team, saying that we don't actually even hit those numbers in terms of what we know. In terms of some of those reserves, a lot of that is in occupied territory. So we'll see how that all shakes out as well. So the geopolitics is something we're going to monitor, the earnings piece as well. But as we're having all these conversations, finance ministers and central bank governors gathering today at the G20 in Cape Town, the group increasingly under pressure from the very things we were just talking about, the actions of the U.S. president, who has whipsawed financial markets with tariff threats on an almost daily basis since returning to the White House. Our very own Jennifer Sabasaja joins us from Cape Town this morning. Jen.
Yeah, Kriti, good morning to you. I'm actually standing by with a very special guest. I have Dr. Jörg Hukies, the German finance minister, who is here. Minister, thanks so much for being here, especially amid a number of things that are going on in the world, in particular in your country. Before we get to the G20 meetings, let's just talk about the progress that we've seen since the Sunday election in Germany. Talk to us about where things are at with your party and others, and what's your expectation moving forward?
Well, the negotiations will start soon formally. At the moment, there's informal discussions going on and planning and everything, but I'm sure that there will be a mutual interest in coming to a quick start and then carrying on the negotiations. And of course, nobody knows what they will bring.
What is your expectation, though, when you get home back to Berlin? What's going to be top priority for you and your team to focus on?
Well, of course, as finance minister, all of the questions around the budget and the financial policy are front and center. But of course, the economic situation in Germany is highly unsatisfactory. So finding solutions and reforms to address that is absolutely at the top of mind for the negotiations.
We are hearing some discussion about potentially increasing the existing special fund in Germany, 200 billion euros to go towards the army. Can you talk to us about the decision behind this and whether or not that would be preferable to other options that are out there right now?
Well, it's a discussion that the German parliament would have to take. Legally, it is possible. The Parliament has a mandate for the remainder of the term, but it's up to the Parliament to decide what will be the content of potential agreements. Certainly, strengthening our defense effort in the course of the next years is something extremely important because we do want to strengthen the European pillar of NATO.
So what does that look like for you in terms of your role in being a part of the negotiations?
Well, the finance minister always has to have an update and a knowledge of the budgetary constraints, and those are quite strong in Germany. Just for this year alone, we still have several billions to cover to close the budget. So in that sense, the input of the finance minister is always on the budgetary questions, the tax questions, and of course also the economic questions.
So then, if we're looking at a time horizon, I know you said Parliament still needs to talk about that. Have there been discussions about what this could look like in the next few weeks, months, potentially years?
Well, preliminary, yes, but of course this is something that would now have to start. The leader of the CDU has a clear mandate. We congratulated him for the electoral victory, and he now has the role to start the negotiations.
Do you think the Social Democrats, though, will still be a part of these discussions, and how do you see that? How do you see the Social Democrats working with the other parties then as well?
Well, I mean, just from the result of the elections, it's quite obvious that the Social Democrats will be involved, and the Social Democrats have said that we are open to negotiate, but of course nobody can predict what the results of such negotiations will be and whether they will lead to a formation of the coalition that everyone is anticipating now.
Could the delay, though, present a challenge for Germany, especially when you consider a lot of the economic challenges that the country is already in?
Well, the goal clearly is to come to a quick conclusion, but what I'm just saying is nobody can. Of course, abstractly, everyone knows we want, in the interest of the economy, to get done quickly, but nobody can predict whether that will work before the discussions and the negotiations have started.
So then considering that, Minister, you're here at the G20 meetings. What is priority for you when you meet with your counterparts here? I know you're saying you have a number of bilaterals planned. Can you give us some insight into some of those?
Well, first of all, the priorities of the South African presidency are very close to us. The whole question of global economic growth, global economic cooperation, strengthening the financial system, thinking about the financial architecture of working together on development. All of those priorities are very near and dear to our hearts, and so we hope to make progress in the next day or two on this.
Talk to us, though, about what progress looks like, right? Because there's a lot of variation in progress, right?
Yeah, I mean, I think for today and tomorrow, we are still negotiating on what form of statement will come out of this meeting. At the moment, it looks most likely that we will not have a formal communique, but rather a pronouncement of the presidency. But that's quite normal in the G20 early on in the year.
Does that have anything to do with the absence of some of your other counterparts from the West?
Well, not only the West, several ministers, and that's, by the way, also quite normal that for the first meeting of the G20, not all of the ministers physically are present, so that's not completely unusual. But usually the year evolves as we move from the February early meeting to the spring meeting, IMF, World Bank. There's usually a G20 meeting there. So as the year progresses, I'm sure we'll get more clarity on how to define progress.
Minister, when it comes to budget, to defense spending, there are some concerns about seeing a retreat from some, in the U.S., Europe, of aid in particular, and potentially that shifting over to defense spending. Is it fair to say that we're seeing the West retreating slightly and leaving holes open for countries like China and Russia to step in? Well,
I can only talk for Germany, and we are meeting our commitment on the so-called ODA requirements, so the development assistance quota of 0.7%. So we are sticking to our obligations, and that is very important, I think.
So you don't think there is a risk that contributions to aid will be at the detriment, or contributions to defense spending will be at the detriment of aid?
No, I mean, as I said, we are meeting our obligations to the international community as requires development aid. But of course, I can't talk for other nations. But for Germany, I can say that for the period that we are foreseeing and that we had, so everything from the last government tenure, the draft budget that we have for 25, we are in full compliance with the development assistance targets that we've committed to.
So then what role do you believe China and Russia then could potentially play where a country like the U.S. is retreating in terms of being a global power?
Well, this is exactly why we want to strengthen our presence. And in Africa specifically, with the Compact with Africa, which is a G20 initiative coming from the German presidency in 2017, we want to make offers to the countries in Africa to work together with the G20 countries in the Compact with Africa. But that's explicitly not one against the other, but the G20 jointly providing support to countries and working with countries in Africa together on the Compact with Africa as a specific example of what the G20 is doing in this context.
So Germany expecting to stick to that then moving forward?
Well, even expanding it. We've seen in the recent years a strong growth in the membership of the African countries that want to participate in the G20 Compact with Africa, which has as a clear target to engage in economic reforms, to involve the private sector in investments, to strengthen governance, and to therefore set positive growth impulses supported by the G20.
Okay, we'll leave it there. Unfortunately, we have to let you go. That's Jörg Hukies, the German finance minister, here at the start of the G20 finance ministers and central bank governors meeting in Cape Town. Guys, back to you in the studio.
Thank you.
Jen, great conversation. Thank you very much indeed. Jennifer Dabasaja with the German finance minister on the ground in Cape Town for us at that G20 meeting. Plenty more coming up, of course, on the show, including interviews with Christoph Jurek at the Munich Re CFO. That is an exclusive after they came out with some earnings that beat the estimates. So stay tuned for that conversation. Meanwhile, Leo Birnbaum, E.ON's CEO, on guidance that came in higher than expected. That conversation around the energy story will be consequential, particularly with the German lens. And Jürgen Esser, Danone's deputy CEO and CFO. That's an exclusive conversation. We'll talk about demand from the consumer around yoghurt and dairy products and some of the vegan options as well. And Ben Locock, Trafigura, switching focus from vegan food to global oil, the global head of oil. A conversation, of course, so many touch points here, whether it's Iran, sanctions, Ukraine, Russia. That is a conversation certainly not to miss. That is coming up. This is Bloomberg.
We're just about 40 minutes away from the opening trade in Europe. Futures are pointing to some real positivity. Your Stoxx 50 futures flying this morning, high by 0.7%. The DAX, of course, outperforming as usual, but perhaps a little bit of a rebound from some of the market moves we saw yesterday. A lot of that driven by the recent softening of U.S. economic data, suggesting the Fed may need to cut rates this year. Traders now pricing in 225 basis point cuts for the remainder of 2025. Let's walk through how this affected the markets. Bloomberg's Valerie Teitel is all over it. Val, walk us through it.
Kriti, yesterday we were really trading the narrative around a growth scare in the U.S. This string of economic red flags added into the mix. Really a phenomenal rally in the Treasury market. Yields down 11 basis points in the 10-year sector. It's taken these yields now 50 basis points off the highs seen in January. It was all down to that consumer confidence mix, which is added onto a string of economic misses recently. Go through them briefly. That big retail sales miss, biggest miss in 2 years. PMI services, UMich economic sentiment, the profit warning from Walmart, and that consumer confidence miss yesterday meant we were trading that growth scare with yields down, equities in the red, even oil plummeting near 3% at some time during the session. It's putting equities on a shaky footing ahead of the giant earnings release out from Nvidia later today. We're now 3% down in the S&P 500 in the last 5 sessions, and the outlook is even worse in tech. NASDAQ has slid 4% in the last 4 sessions, and that Mag 7 index dropped into correction territory, now down 10% from its peak in December.
Certainly some scary moves in yesterday's price action. Bloomberg's Valerie Teitel walking us through all of it. We thank you so much. Let's bring in an expert here, Maria I'm going to say this right. I'm so sorry. Demirtaziz, Economic Strategy and Finance Program Leader at the Conference Board and former Deputy Director at Brewel. Maria, you're a friend of the show. I apologize for the mispronunciation. Let's start with the economic story that Valerie was just talking about, which is, of course, this U.S. economic resilience that we've seen. So much of it, it feels like Donald Trump has been leaning upon to then enact some of the tariff and arguably inflationary policies when it comes to the rest of the world. Walk us through how you're interpreting that in the context of the fact that we did actually get weak consumer confidence data. It's targeted the markets, as Val pointed out. How does that square in your mind?
Yeah, I think this is exactly the issue is that I believe the new drop that we saw, actually rather sharp drop, that we saw in consumer confidence is very much, in my view, a reflection of the worry that tariffs will be very inflationary. And that, of course, makes sense. However, I think the story is not finished yet, because in the latest CEO confidence survey that we did in the US, we actually found that CEOs are extremely upbeat about the US economy. In fact, very exceptionally upbeat by comparison to previous numbers. The two pieces of information are contrasting each other, and therefore the impact on the outlook hasn't cleared out yet. So I would need to wait a little bit and see, first of all, how tariffs play out and whether indeed we will see the inflationary outcome, and of course see what the CEO is thinking as the big investors in the US economy.
Maria, walk us then through how Europeans should be responding to something like that. The economic levers at play that Europe has, given that not only are we talking about massive deficits on this side of the Atlantic as well, but now this massive push into defense spending. Where is the money to do both?
Okay, there's two things here. First of all is the tariff issue. Of course, we haven't seen any tariffs yet. We have heard threats of tariffs. The European Commission is for sure preparing a list of products, of US products, that they will impose tariffs on, with the principle of being proportionate, meaning that if we get a 25% tariff on steel and aluminum, which is what we've heard from President Trump, then there will be a list of products that will match dollar to euro the exact tariff size. Next to that, and this is a little bit worrying, the European Commission is preparing what in Brussels talk is known as the bazooka, which is the anti-coercion instrument. This is a new instrument that was created in 2023. It has not been used yet, but the threat of being used is very much real. And the European Commission is preparing the legal grounds for using that. This is an instrument that goes beyond prices. It can go down to export controls, preventing US firms from participating in public procurement, anything that can actually shut off US companies outside the European economy. This is not to be used lightly, but it is being prepared as, if anything, a deterrent for tariffs. So that is on the trade side. On the military side, of course, after the Munich Security Council, is fair to say that European governments are very much in disbelief, losing effectively what had always been a US guarantee, which effectively means, as you said, a massive increase in military spending. And that, of course, is already started. The European Union now spends about 1.9% of GDP in military expenditures, with another 0.3, 0.4 of GDP have been committed for the next 3 years. It's not enough. We need to go to 3.3, 3.4. It's not quite doubling, but it is almost there.
Yeah.
I'm not sure how we're going to get there in what term, but certainly we will do that.
Maria, good morning. How do you compare, how do you bring those two stories together then? Does the spending around defence offset the impact of Trump tariffs?
In what sense? I don't think on one kind
in terms of the outlook for economic growth, as you project forward for the economic outlook for the Eurozone, does the fiscal response and the fiscal impulse around defence spending, does that offset those potential tariff impacts?
Well, first of all, we need to see whether we will get there in terms of tariffs. So there's still space to negotiate in this respect. The fiscal impulse that will come from defense spending certainly will be expansionary in the short term. I don't think you can argue that in the long term, spending on military and defense is really a credible growth model. But certainly in the next 2 to 3 years, it will have a positive impact on the economy, and it will stimulate research on dual-use technologies, which, of course, in itself will be extremely helpful in closing the innovation gap. So I see good news in terms of the fiscal impact. Whether they will counteract the possibility of tariffs remains, of course, to be seen. And I remind you, of course, that both tariffs and fiscal expenditure are both inflationary. So you also have opposing forces in this respect.
So, Maria, you have the impact of tariffs, you have the impact of the retaliation against tariffs. But really, when you hear Mario Draghi saying that Europe has successfully put tariffs on itself, is that more the thing that the EU needs to be worrying about?
Absolutely. The internal tariffs, and they're not really tariffs, they are barriers to trade, but they are equivalent to tariffs in terms of the impact that they have on trade. These are very big internally, simply because the single market is not complete. The estimates that President Draghi uses are that in manufacturing, the barriers to trade amount to a 45% equivalent of tariff. And when it comes to services, that amounts to about 110% of tariffs. So, you know, Europeans, if we want to make progress in increasing trade and remove these barriers to trade, we need to look inwards.
OK, Maria de Mertzis, Economic Strategy and Finance Programme Leader at the Conference Board. Really fantastic analysis in terms of how to think about the defence spending coming through from Europe, how that positions the economy amid those tariff risks as well, and some of the internal domestic focus as well that's coming through from Europe.
Interesting that she doesn't see much of a boost to economic growth, given that it could be US companies that benefit from this spending. And indeed, you didn't see that much of a move in euro dollar off the back of the plans for this 200 billion euro fund. So maybe traders agreeing.
Yeah, this is, the playbook that you've seen, right? In Italy, for example, the outperformance there driven by the fiscal spend. And you saw in the Biden administration, so much of it, the government funding a lot of these corporates. Is that where Germany is headed next? They're certainly trying to be. And
there was a nod there from Maria as well to the inflation impact. And so the follow-up question would have been, if we'd had time, around the ECB and whether it changes the calculus around how far the ECB can go in this environment as well, the implications, again, to the sovereign debt markets. Coming up, Munich Re, talking of interest rates, beats its full-year profit target and announces a €2 billion share buyback. The German reinsurer's CFO joins us for an exclusive conversation. We'll talk about the LA fires, we'll talk about asset management, we'll talk about rates. That's coming up. This is Bloomberg.
30 minutes from the start of the opening trade. Futures pointing higher on both sides of the pond. Looks like we're going to get a bit of outperformance when it comes to the DAX. And if we flip over to the bond space, you've got yields steady across Europe, but we do wait for gilts to open. Not expecting too much of a reaction to Starmer's defence spending announcement, given really it's just a reallocation of funds. But a bit of breaking news, Tom.
Yes, the lines crossing from China. It's a redhead across the terminal. China and the government there planning to inject fresh capital into the banking sector. $55 billion is the tag in terms of the number that we've got. So that's 400 billion yuan, $55 billion. They had hinted and suggested this was coming in September. We didn't have the details. So some of the biggest lenders in China, including Agricultural Bank of China, Bank of Communications, will be amongst those getting fresh liquidity. Of course, a number of those banks have absorbed the losses from the real estate sector. So there was a need, it was assumed, for fresh liquidity. Now it's coming through. This is the latest attempt then for the Chinese authorities to shore up the banking sector. Again, under pressure as a result of the real estate moves that we've seen now with prices continuing to fall around houses. So this is another arrow fired into the heart of the Chinese economy that, of course, authorities will be hoping puts a floor under it. We'll look ahead to the National People's Congress for more details in terms of stimulus next week.
And a little bit of strength, as you point out, on the yuan off those headlines.
Yeah.
We'll see whether or not that actually sticks. And speaking of things sticking, let's talk about some of the earnings that we are getting this morning. Munich Re beat its profit target for last year, despite a slight drop in fourth quarter earnings. The German reinsurance giant also announcing plans to return, get this, 4.6 billion euros to shareholders through a new buyback and increased dividend. Joining us now for an exclusive conversation is the CFO of Munich Re himself, Christoph Jurika, joins us this morning. Christoph, a pleasure to have you on the program. Thank you so much for joining us this morning. Walk us through some of these earnings pictures. We know that the insurers have been sitting on a good chunk of profits for the last 2 years or so. How sustainable is this return to shareholders?
Well, first of all, good morning, and well, thank you for having me. It's a great pleasure to be here this morning and being able to present so excellent results as we have this year. 5.7 billion net income is a significant outperformance compared to our targets, which was 5 billion, so more than 10% outperformance. And not only this year we were able to surpass our targets, but it's the fourth year in a row. And what is particularly pleasing in my view is it's not just based on, you could argue, maybe good luck in one or the other business field we're in. No, it's a great operating performance across all our segments. And by the way, in a year where natural catastrophe losses globally amounted to $140 billion for the industry. So it was a busy year when it comes to nat cat losses. And in a year like that, to exceed our target is particularly extraordinary.
Christoph, you mentioned those natural catastrophe losses as well. Let's go there next. And this idea that, of course, we know so many of the insurers after the fires in California have been pulling out from that region. Can you just walk us through your strategy on dealing with some of those climate-specific zones? California is one example. Florida is another, and plenty of places like Greece on this side of the Atlantic. How are you thinking about your strategy moving forward, given the losses you just mentioned?
I mean, first of all, our thoughts and hearts are with all the victims of these disastrous events, which we see more and more frequently globally. So I think what is absolutely key for us as an insurer is that we update our models regularly and that we include whatever is available as most recent scientific research on the impact from climate change. We immediately include it in our model and make sure the risk modeling is absolutely up to date. And then it's, of course, relevant that you include those considerations, those model updates also when it comes to your pricing and risk management underwriting capabilities. You apply to the various markets and help the societies there to invest more, for example, into prevention, into measures which help the society to cope in a better way with the significant changes we are experiencing. We are here to help. We are here to support the society when it comes to these nat cat events, and I think it's really a very important task the entire insurance industry has.
Christoph, Lizzy here in London. I mean, that's kind of what you are thinking about, what you're doing in response to these climate disasters. But the Zurich insurance CEO, Mario Greco, was telling us that after the wildfires, really there needs to be a whole rethink by cities of how they're planned and that actually the way we live needs to change. Would you go that far?
Well, as I said, prevention is absolutely key. And you know, if we experience losses, big natural catastrophe events in some regions over and over again. So think about houses built very close to rivers, and you traditionally experience losses quite regularly. I think it's obvious that then we have to invest into prevention, either by changing something on the risk likelihood there, having different kind of, I don't know, walls and protect yourself against the floods, or in a more extreme case, rebuild the house elsewhere and just make sure you build the house in a safer environment. And I think this is really the thoughts we need to have now, how to, in the various countries, in the various societies, how to better prepare for the change, which is certainly going to affect us more and more in the upcoming years.
So what is the single biggest risk for an insurer these days?
Well, we are so broadly diversified. I can only speak for Munich Re here. So we are so global. We are insuring risks all over the globe, all kinds of risks, not only natural catastrophe risks, all other kinds of risks as well, be it in the non-life, in the health insurance space. We are so well diversified that intrinsically, I'm not afraid of any single risk. We are able to cope with all of them. But if you think about what the biggest change, the biggest possible risk for us as a company would be, I think it's clearly geopolitical risks. We are living in a more and more uncertain society. Political beliefs, which had been stable for decades, seem to be less stable or less certain nowadays. And I think this is the biggest risk we have currently.
Well, it seems obvious then to follow on your views around the German political landscape. Christoph, good morning. How confident are you we're going to get a stable government out of Germany, a stable coalition, and in what time frame? And what does that mean for your business?
Well, that's early days now. The election is just a few days behind us. Obviously, I do very much hope that we get a stable government as early as possible. I think it's absolutely necessary now that decisive action can be taken on a political level, be it in Europe, be it in Germany. And therefore, I very much do hope that the political parties come to terms very quickly. But I'm not any closer than you are, so I cannot predict anything and cannot tell you how quickly this is going to happen now.
If we do get that, does that step up capex? Do you get the animal spirits revived, do you think, in Germany, if that outcome comes to pass?
Well, I would only say never bet against Germany. If you get a stable government who would really make sure that the environment, that the circumstances for the German economy is improving, then I think the German economy will recover quickly. And I'm very confident that Germany will be very quickly back on a track to success.
Well, Christoph, you said don't bet against the German economy. Some people aren't actually. They're actively investing in it. And through a wave of consolidation, actually. We've seen that in Commerzbank. We've seen that in stakes in the auto sector as well. Christoph, I want to take your perspective of it because we know there's been a wave of consolidation in the asset management industry specifically. You own an asset manager yourself. Are you looking to scale up? If the argument is don't bet against Germany, are you in the perfect position to do that via that business?
Well, indeed, asset management is very important for us. We own an asset manager, and we are very happy with the position which we currently have, because our asset manager encompasses many skills, very really market leading, certain industry sectors, certain asset classes, certain geographies. And wherever we are not market leading in what we are doing in-house, we are using external asset managers anyway. And by doing so, we are in a very sweet spot. We have a very good combination of in-house capabilities, which are market leading, but we can add here and there additional skills where we need them.
Christoph, you said that the biggest risk is kind of political, maybe geopolitical. And we've talked about the German election, but there's also, of course, Donald Trump back in the White House, and policy can change with the click of a Truth Social post. I wonder how, in the world of risk, you're dealing with that, how you're changing your resources, whether you're using AI more in your models to process the ever constant news flow.
Well, AI is an important element, but let's look at it more generally. Diversification is absolutely key for us. Already in the past, we were never able to predict anything concretely, but we had to prepare for all possible scenarios. Now, in an even higher uncertain world, in a world with even higher uncertainties, it becomes more and more important that you're broadly diversified and you can cope with whatever happens independently if you personally think it's very likely or not. And this is how risk management works. So we basically try just to be prepared for whatever happens. And again, in the past, it always worked.
Christoph, let's take that one step further here. You're already seeing that being directly addressed in the fiscal dynamics, of course, in Germany and across Europe, but you're also seeing it developed on the monetary front as well. There's an expectation here that the ECB is going to be cutting for some time. How does that affect or perhaps minimize the risk premiums you can charge your clients?
Well, yeah, I mean, interest rates is a very relevant topic for us as an industry overall. The higher the rates are, the more also we are able to invest at higher yields in our fixed income portfolio. We've been benefiting from that for the last number of years quite a lot. Now, if you look at our investment portfolio, we have also a significant footprint in the US, where, as you know, interest rates are significantly higher anyway, and we are prepared to take advantage of that situation even more going forward. So, in a way, we a bit distant from developments which would affect only one geography like Europe. But then on the other hand, of course, we do invest a lot in Europe as well, and the lower the interest rates are, the more our earnings would be burdened a bit. To hedge that effect, we did realize some unrealized losses already last year in the course of our year-end closing, and reinvested early on significant amounts of our bonds to make sure we still get the higher yields, also in light of potential reductions going forward.
Christoph Schuriga, we look forward to seeing how this all plays out. Munich Re CFO joining the program this morning on a slew of topics from the geopolitics to the monetary policy as well. You heard it there, though, that the ECB and that reaction function that you are starting to see in response to the geopolitics, by the way, already showing up in somehow the ways that corporates are hedging and preparing for what's next.
Yeah, indeed. And, the ECB having to tread that difficult line between inflation and growth, and the question whether actually they're focused more on growth than inflation at this point.
The stock is up 28% year to date. It's called higher in the session today as well, so we'll watch that. But certainly good lines coming through. It's a reminder that there is strength in this Eurozone when it comes certainly to the insurance sector. And we've had a reminder of that on the earnings front, with cash being returned to shareholders, at least for now, from this company.
Yeah, perhaps for insurance, but not necessarily for Stellantis. This morning it's issued a cautious outlook after a 70% slump in net profit. We'll bring you that and your other stocks to watch next. This is Bloomberg.
Welcome back. We are 15 minutes from the opening trade. The mini market tantrum that we've seen over the last few days, particularly focused on the US, is abating, at least for now. When you look at futures, up 0.4% on the S&P E-minis. Here in Europe, pointed gains of 0.6%. Nvidia, of course, the earnings story of the day. Kriti, what are you watching for?
Yeah, rebound in the works, perhaps after some of the carnage yesterday. I want to really zero in on that carnage because we saw it pretty enormously in the bond market, a 10 to 11 basis point move in the bond market, all because of this data set here. Consumer board expectations 6 months into the future falling below 80. Now, this is important. I'm going to walk you through what looks like a very scary chart right now. But there is a dynamic in play that when this index falls below 80, people are forecasting a recession. And in previous iterations, we have seen that happen. That's what this chart suggests, that every time it's dropped below 80, a recession somehow comes up 6 months later. That being said, it is not a hard and fast rule. We've seen this with the inversion of the 2s-10s curve as well. So really keep an eye on this. But I think it's worth highlighting that we have seen this idea of American economic resilience start to shake, start to wobble just a little bit, because you're starting to see elements not just in this data set, but in the idea that perhaps some of the hiring and some of the job losses are increasing, elements in the beige book, inflationary costs, and of course the consumer sentiment as they look at the potential impact of tariffs that we're going to see. So whether or not we can actually see the economic resilience that we have really baked into these markets continue over the next 6 months, well, the folks in the States don't necessarily think that's true, Tom.
OK, is the US handing the baton on the question of technology and the resilience there to China is a question, given the innovation we're seeing as well. Markets Live executive editor Mark Cudmore joining us for a beat on this. Mark, talk to us about the divergence we've seen. It's pretty pronounced, isn't it, when it comes to the tech stories of both the US and China. Is this likely to be sustained?
It's absolutely phenomenal, the divergence we're seeing. And you're right, Tom, to emphasise that the extraordinary rally that we've seen this year in Hong Kong stocks primarily, but also in China, is very much tech-driven. It's not about the real economy in China. I think that's really important here. I don't think this is necessarily a passing of the baton. It's not a change of the guard. What it is that US tech stocks were exorbitantly expensive and just irrationally so on a sustained basis. Meanwhile, China tech stocks were just way too cheap, way too discounted. And what we're doing is we're correcting some of that misalignment. So Chinese tech stocks are starting to become more fairly valued, and we're removing some of the premium that was seen to US tech stocks. I think both these moves are rational. I think that we're getting to a more realistic place. I won't say the continued divergence of performance will extend, but it's not going to reverse from here. People have realized that China and Hong Kong stocks can gain from the AI tech boom, and US tech stocks aren't the only show in town.
Mark, Kriti talked about the recession fears. You warned us about them yesterday. Surely they haven't gone away despite the Trump administration dangling these tax cuts. I wonder how low the 10-year yield could actually fall.
I think the 10-year yield will go a chunk lower in the coming weeks. This is just a temporary bump higher, given an extraordinarily large move lower, particularly yesterday, but also over the last couple of weeks. The narrative is changing. The growth concerns in the US are going to remain for some time at least. In the very short term, will probably be dominated by Nvidia earnings today, and that may mean, any ask can go anywhere in the next 24 hours, 48 hours or so. But overall, 10-year yields are going to go lower in the coming weeks because growth concerns in the US are coming back into the fore. Now, whether this means we're actually going to get a recession is a completely different issue. What it means is that we're going to disappoint elevated US growth expectations. The rest of the world is doing better than feared. US is probably not going to deliver as much growth as has been hoped for as recently as the last few weeks.
But Mark, isn't the antithesis to that argument simply that if you do get a tariff uptake across the world, that's ultimately inflationary and pushing those yields in the opposite direction?
I think it is ultimately inflationary. To what degree will wait to be seen. But I think it's dominated for now by the growth concerns. We know that tariffs are negative for growth. We know that they're negative for US growth. And the uncertainty in flip-flopping is particularly damaging for US companies. So all the cost for this at the moment in the short term is on the US economy, and that's going to feel the pain. Now, it might ultimately be inflationary as well, but it's not going to be significantly inflationary if the economy is getting really hurt. So, yeah, people will feel it like a little bit of a stagflationary impulse, but it's the stagnationary side, it's the growth side that'll dominate more in the short term. So in the short term, at least, US 10-year yields have further to fall. I actually think they'll be higher again later on in the year, but that's a story for another day.
OK, the story for today. Nvidia, Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you. And remember, you can get up-to-date analysis and insight from Mark and the team. Just go to MLIV Go on your terminal. Now, it's a busy day for earnings again. Let's go to our stocks to watch with Joe Easton from our equities team. Joe.
Morning, Lizzie. So Stellantis giving a really negative outlook in their latest report and also guiding for a big drop in profit once again. Now, this stock has had a terrible run. We can see it there down around 45% on a one-year basis, partly due to the concern around EV competition, but also the strikes as well. And there are a few analysts with sell ratings on this stock today, 4 of them now, and potentially they might be a little bit pleased by the negativity coming through on that one. Could be a bit weaker. Then we've also got a massive share sale coming through at Novartis. This is related to the Sandoz family. That is the generics business that was spun out previously. We can see pretty good time to be selling shares of that company, given that rally, cashing in on a bit of the boost for Novartis stock. But given it was priced at around a 3% discount, we're potentially going to see Novartis slipping in trading today. But one of the biggest share sales we've seen in Europe for a number of months, around 3 billion euros for that one. Then in terms of BP, it's all eyes on the capital markets day today. They're going to be potentially looking to offload their Castrol unit and also potentially going to be scaling back even further their focus on renewable energy. And we can see the underperformance of the stock versus Shell is a big reason that we've seen a lot of activist interest in this one. And we also see a few sells on that one as well, but mostly buys still potentially more positive in terms of the makeup there. Then in terms of rating changes, Kepler Chevrolet is picking the bottom out of the luxury stocks today. They're upgrading LVMH, also Burberry, also Kering to buy, but they downgrade Hermes, Birkin bags, not fancy enough for them. That one comes down to hold given the valuation. And a big one just hitting the wires a few moments ago, Siemens raised to buy at Bank of America this morning. That could be a strong point on the DAX index today.
Our equities reporter there, Joe Easton, walking us through some of the major individual movers, of slew of earnings, of course. But then you do have this rebound in the futures picture as well. I mean, this outperformance in the DAX has been a theme for the last 6 weeks or so. You would think that after some results of the German election, you would maybe see a little bit of that rally pull back. Not today.
Investors still waiting for answers to two questions. One is how quickly the coalition gets formed, so the time frame, and then will they find a mechanism to change the debt brake or at least reform it to some extent. But to your point on the DAX story and the German equity story, the MDAX, of course, the mid-caps has underperformed. They get about 40% of their revenues from the domestic market, so there's a case to be made. That's where you want to get the exposure, but first you need to answer those two questions.
Yeah, but in answer to those questions, we heard from your cookies earlier. He sounded like he was teasing us about whether the coalition is going to come at all, when it's going to come, because, of course, there are the questions of what Merz is going to have to give away in order to get that grand coalition.
Absolutely. I mean, to me, this is actually a question for you, perhaps. I think just in the outperformance that we've seen, maybe some of it isn't fundamentally driven at all. Maybe it is a little bit of a haven story in the, arguably, pardon the pun, the defense argument of Germany. If you're a European investor right now and you're looking for safety, do you hop into American tech or do you hop into German defence?
Which is a really intriguing question, isn't it? That we wouldn't have probably posed towards the end of last year. But given the upside we've seen from the likes of Rheinmetall, just year to date, more than 40%, that does look like a pretty safe spot to be as you're looking at potentially $200 billion of additional defence spending in Germany. And question marks continued around the valuation story of big tech. But that answer, or at least that question, will get a little bit more clarity on the back of the Nvidia earnings later today as well. 200
billion euros there out of Germany, maybe boosting Rheinmetall more. But interesting as well for the likes of BAE Systems, where the Starmer's money is going to go to UK firms when it comes to defence.
And it's just a fascinating one because at the end of the day, you have to factor in the currency impact as well. And we've seen a slew of economic data. German consumer confidence hitting at the top of the 7 as well. And it didn't even budge the currency there as well. So a lot to pose. We're going to dive into all of the details. Plenty of markets conversations ahead as, of course, investors not only digest the geopolitics, but digest these slew of earnings as well. Futures in the green. It's the opening trade next. This is Bloomberg. A few minutes to go until the opening trade, seeing some mixed sentiment because we thought we were really going in from yesterday's trade on maybe a negative note. Maybe I'm wrong here, but let's just walk through what the last 24 hours have looked like in these markets. This white line, of course, how we started it or ended the story in Europe. Really a lot of positivity. European stocks were flying until they weren't, following that U.S. data. And you did see that consumer confidence really bring back those economic resilience concerns. That was this big drop here, only for the rebound to actually manifest. Does this all change with some of the Nvidia earnings, Tom? That's, I think, the question of the day.
That could be the short-term make or break for these markets. Other earnings stories as well coming through in terms of Munich Re, E.ON as well. Munich Re to the upside, so watch that in terms of the insurer basket, particularly when it comes to the DAX. The DAX pointing to gains of 0.6%. Across the Stoxx 50 futures, you're looking at gains of a similar number, adding 33 points. FTSE 100 futures here in the UK looking to add about 45 points, up 0.5%. The defence story is still part of the mix as well. Lizzie.
So generally a risk-on mood, but not perhaps for Stellantis. You mentioned the many earnings that we had out today. Stellantis issuing this cautious outlook, a 70% profit slump, shares down 45% over the past year. Do they fall more this morning? Also keeping an eye on Sage and the other European software stocks after Workday reported results that beat. And Novartis, the Sandoz family, is selling its stake there. But Kriti, we are moments away from the open.
Absolutely, and this is going to be crucial as well because, I have Guy and Anna stuck in my head. I can't get rid of them, apparently. Tom was talking about the DAX, of course, really flying, and this is important as well when you talk about the context, talk about the ripple effects that you're going to see in some of the other indexes as well, because you're not really seeing an underperformer. If there was one, it might be the FTSE 100. The one thing we failed to mention is that, of course, the China headlines as well. This moves the Chinese markets. Do we see a read-through into the European markets as well? All right, so here we go. The opening trades across Europe. We are about to get those numbers in just a moment. And right off the bat, the FTSE 100, as expected, higher by 0.2% and climbing still as we kind of work through some of those numbers. The earnings story is going to be crucial. The IBEX right on its heels there, about flat this morning. And there's the Stoxx 600, higher by 0.2%, but a tail of earnings here. When we're looking at sentiment, it might be to the upside. But Lizzie, as you point out, the earnings to the downside is going to be crucial. We, of course, have our eye on the DAX and whether or not the outperformance can indeed continue.
Yeah, so I did mention that we should keep an eye on those software stocks after Workday had results that beat expectations, and indeed you are seeing SAP shares up 0.4%. You've got Novo Nordisk shares up 4% after their earnings, Stellantis down 3.8%, and Danone also posting their earnings today. Resilient sales growth helped by higher volumes. Those shares higher 1.3% as things stand. But Tom, on a sectoral basis, pretty mixed, actually. You've got about 3/4 in positive territory.
Basic resources at the top of the list with gains of a little over 1%. Copper is in focus for us today in terms of metals, given the executive order signed by President Trump that could lead to tariffs on that particular metal. Dr. Copper up in the session, of course, by about 1%. Oil also higher by 0.3 on Brent and a similar number on WTI, though interestingly WTI is still in the 60s. Basic resources then gaining 1.2%. Banks in focus as well. Industrials and consumer technology as a sector up 0.6%. On the downside, media taking a knock at 0.9%, Kriti.
We should mention, of course, that we are awaiting those Nvidia shares. You hinted at it there, of course. We saw in the likes of ASML and Schneider Electric actually seeing a little bit of positivity and lifting the market just a little bit. I should also mention AB InBev shares are halted at the moment, so we are going to wait and see what the shakeout of that earnings story looks like. But as I said, the tech story very much in focus. Schneider Electric right off the bat higher by a stonking, I think was the word Lizzie used earlier. Schneider Electric higher by about 2% there. But then you're also seeing some of the other heavyweights really move this market. LVMH and Novo Nordisk, a tale of two heavyweights there. Novo down about 1%. LVMH higher by about the same margin.
Interesting that you bring in what is happening when it comes to the space, when it comes to the auto space. Of course, we touched on that. Stellantis. You were talking about AB InBev. Their earnings came in very strongly, and so we're going to wait to see what the print is. But it was much better than expected. The losses that they saw, the softness they saw in the North American market, less bad than expected. The volumes, of course, that is part of the story when it comes to AB InBev. But that suggests that when it comes to the maker of Budweiser, things are starting to improve. That is going to be a key stock, of course, to watch when we finally do get that print. Again, on some of the downside, the pressure coming through for the likes of Novartis, Stellantis now, and that is not a story that is just idiosyncratic to the Jeep maker. Company down 3.8%. The auto sector remains, of course, challenged.
OK, so we continue to wait for the DAX. Not prompt again, but we can discuss the rest of the markets and all of the many themes that are feeding into them this morning. Emma Wall, Head of Platform Investments over at Hargreaves Lansdown, joins us now. Good morning, Emma.
Good morning.
We've been talking about the reaction in Treasury yields yesterday to that US consumer confidence data. And yes, we're seeing Treasury yields back up again today. But if we zoom out and we look at the big picture, do you think that it is true that US exceptionalism is over? Is that the new narrative?
I don't think it's completely over, but the market has definitely decided to diversify, and actually so have our clients. What I think is really interesting is, despite the fact that actually we're reasonably optimistic about Nvidia, we can come to those results in a minute, our clients are definitely off when it comes to Mag 7 stocks. Now, part of that is performance. They have obviously lagged the S&P 500 year to date. And of course, we had that significant wobble from Nvidia in January from DeepSeek. But I think this is a tale of two halves. It's the fact that actually Mag 7 has done so well and then come off the boil. And so therefore, people have looked to take gains. But there's also a switch. And we've seen in the last couple of weeks, and in particular the last 24 hours, our clients moving into defence stocks off the back of that decision to increase spending and obviously the news swirling about Ukraine. I do think, however, that they continue to be risk-on when it comes to US. It's just broader than the Mag 7. We do think that actually there continues to be opportunities in the US. And if we look at collectives flows, our clients agree. So actually, if you're looking at kind of broad ETF baskets, those are still in favour, still looking at the S&P 500, still looking at the Russell 2000. But in terms of that very concentrated market in the Mag 7, actually demand we've seen in the last month significantly drop from our clients.
Well, Emma, is that the new trade du jour then? I mean, you talked there about the defense spending, and we've seen this really concentrated, of course, in the German market. This morning, the DAX open and flying yet again higher by 0.8% at the open. If you are a European investor and you are cautious on the world and you need to hedge it through the equity market, Do you do it with the Mag 7 in the States, or do you do it with defense stocks in Germany?
I think it's a bit of both. What's really interesting is, despite the fact that we've seen considerable outperformance from the likes of, say, BAE Systems and Rolls-Royce, we're continuing to see demand there. I mean, Rolls have its results out tomorrow, and they are expected to be really positive. But this increase in defence spending, of course, the UK has been one of the first to move and committing to 2.5% GDP, with a move towards 3% GDP, is expected to be echoed across Europe. And that defence spending has got to go somewhere. And so there's those companies are likely to be net beneficiary. I think one of the really interesting things is about Germany. I know you've been talking a lot about it this morning. I still think it's very early days in terms of politics. We're still 2 months out from forming a government. We don't know what those policies will be. Germany has really struggled when it's come to economic growth, but the pressure certainly is on when it comes to defence spending. And given that the US is stepping back from those commitments, Europe will have to step up. And so this does look like an interesting play, despite the fact that a number of stocks have done incredibly well over the last couple of years.
And just worth noting, just for our viewers, that AB InBev is absolutely soaring in the session today after beating on its earnings story, rising close to 10%, fourth quarter organic earnings beating across the board for AB InBev. Very strong numbers for the maker of Budweiser. Let's get back to the broader story. Is there a China potential, Emma? Is there a potential China impulse that European equities can also benefit for as we look ahead to maybe more fiscal announcements? We have the details about a potential recapitalisation of the banking space for the first time since about 2008 in China. That came through today.
Yeah, I'm cautious about being too bullish on Europe, despite the fact that we have had quite significant tailwinds over the last couple of weeks, because there still is so much political uncertainty when it comes to Europe, and growth is so anemic. So we're actually neutral on Europe, despite the outperformance from the DAX. We think it's a really great time to take gains and go neutral on Europe. And despite the fact that actually the US has done so well, although albeit the larger cap stocks have wobbled year to date, in particular in that Mag 7 space, we actually are most bullish when it comes to the equity market on US smallers. That said, where we think the most interesting and compelling investments is actually in fixed income, but you'll need to go with a dynamic play on this. So look for actively managed collectives where the manager has that ability to be dynamic when it comes to the fixed income market and really take advantage of volatility. Emerging markets, we are still cautious on. We do think actually the war with the US has only just got started, and so for us actually that's a neutral weight.
An interesting one. We'll see how it all plays out. Emma Wall, head of platform investments over at Hargreaves Lansdown. We thank you so much for your insights this morning. Let's get a quick check on those core six, the heavyweights that are moving this market. We mentioned it earlier, so the Schneider Electric and LVMH story, of course, both soaring this morning. What isn't, though, is Novo Nordisk, and that has been a continuation of the consumer story in the States, but also kind of the concerns around the longevity of that company, down about 1.2%. The rest of these companies kind of standing in the middle, but ASML, Schneider Electric, positive ahead of those Nvidia earnings later today. Let's get a quick check on some of the other individual stocks on the move. Joe Easton has that for us. Joe.
So one stock extending gains in the open of trading is AB InBev, a massive jump for that stock. We were up the most in 3 years for those shares, actually trimming that at the moment. We're up 7.5% at the moment. It was halted, I believe, in a volatility halt after a gain of around 10%, but selling a lot more Bud Light, according to analysts, and that is easing concerns following some weak reports from some of their peers recently. Stella Artois also flagged in the report as a strong performer for the beer maker today, so a big move on that one. Then in the car makers, Stellantis' terrible run continues. This stock down by around 50% over the past year. Yet again, cautious outlook, cautious commentary from the maker of a lot of brands, including Jeep, of course. So that one really coming down quite hard today. Then in terms of the recruitment sector, Adecco, this one actually rising despite a bit of a cut to the dividend. That seems to have been priced in by the market for that firm. Then ASM, now this is not ASML, probably should learn the difference between these two companies. But ASM, this is, of course, a smaller company, a bit of weakness on their guidance as the AI boom kind of calls for that one. Then in terms of the rating changes, LVMH, that one Kriti mentioned, is a gainer. That's after Kepler upgrades the stock, saying it is picking the bottom out of the luxury stocks today. So we've got a bit of a boost for LVMH, up 2%. And finally, Siemens. Bank of America likes that one. They go to buy, citing potentially an increased share sale of the Healthineers stock that they continue to own. They reckon they could offload some of that, boost the capital, and Siemens is up to buy at Bank of America this morning.
Joe Easton from our equities team, we thank you so much. As Joe was speaking, we did get some headlines crossing the Bloomberg terminal, certainly in the credit space. Altice France reaching a deal with creditors to cut about 8.6 billion euros worth of debt. We do know they were trying to get rid of some of their net leverage, and this is one way to potentially do it. We will bring you the updates as we get them.
Yeah, Patrick Drahi's media and telecoms company, of course. That's been a long-running story. It seems like they are closing at least one of the chapters in that story. Keep across that for you. Coming up to the oil space, WTI oil holding just below that $70 a barrel level on concerns about the US economy. We'll discuss the outlook for crude with Ben Lucknock, global head of oil at Trafigura. Stay with us for that conversation. It's coming up next. This is Bloomberg.
Welcome back to the opening trade. We're 14 minutes into today's session. We are seeing green on the screen across the board. I've just been told we are very, very close to a record high for the Stoxx 600. 557.17 is where we're at right now. We need to get to 557.96 to hit that record high. Does that set us up for some sort of pullback? At the moment, it doesn't really look like it. The DAX, however, the outperformer yet again. We're going to see if that does continue. Let's go to another part of the markets, though, perhaps related to this narrative that we are seeing when it comes to the growth story as well. Oil in New York fell below $70 a barrel yesterday. This all falls into the idea of the consumer confidence data that initially dropped the stock market only to rebound. We saw it move in the Treasury market as well. And now, as we see on your screen, it showed up in the oil space as well. Let's bring in a true expert. Ben Lucknock, global head of oil at Trafigura, joins us around the table this morning. Thank you for coming in.
Kriti, thank you for having me.
Lovely to have you. Let's start with this U.S. growth story, because so much of the conversation, we wake up in the morning, we look at all the tariff headlines from overnight, and it feels like the only reason we can get them is because the U.S. economy is still very resilient. There's still plenty of savings. Yesterday's narrative really kind of punched holes in that narrative. Is that where things are headed?
Yeah, I mean, oil's caught between two things, though, because global economic growth is obviously the most important indicator of how you'll have oil price increases or decreases, right? You had some softness yesterday out of the US markets and the US data, but you've also got two wars that have been adding a risk premium to the oil market, different to most other markets, and both of them are in a sort of a peace phase now, let's say. You know, it's been 3 years since the Russia-Ukraine war started. I think the market is well understanding that peace is now highly likely. So some risk premium is coming back out of the market for that. And then the Middle East, that's also calmed down. So oil is a bit caught in the crossfire and is sort of back at the lower end of the range now.
What's the bigger risk, though? Is it the two wars that you mentioned, or is it the China of it all, the Canada of it all, the Mexico of it all? What's the bigger risk?
Well, the risk is to the upside is certainly the Iranian side. So a couple of things have driven oil for the last couple of years, really. There's been the unsettled situation in the Middle East, but then Russia and Ukraine. As it turns out, the Russia-Ukraine war didn't really slow down Russian energy consumption around the globe. It made it deeply inefficient, and you had vessels moving far further than they needed to do. Much higher ton miles were being expended, bunkers were being burned, but the oil was still delivered. But those two issues have now calmed down. The two big unknowns are, how is the US going to deal with its trade issue with China? And then how is the US going to deal with Iran? And I think the Iranian one is the one we need to watch out, because you're back at this low end of the trading range for oil. It's been a $70 and $80 market for some time now. So for all the intraday $1 and $2 moves, not much really happened. You're at the lower end of the range now, so it's one to be careful of.
Ben, what does Iranian oil do to the market premium? If you think if they start adding oil back on, whatever gets us there, whether it's some kind of deal involving the Saudis, some kind of deal involving the US and Trump administration, maximum pressure is being put on Iran right now, bringing them to the table. Iranian oil on these markets, what does that do going forward to pricing?
Yeah, I mean, it means that it makes it harder for OPEC Plus to bring their barrels back. I mean, this has been a well-telegraphed idea that's been around for a while. I think OPEC Plus has been managing the market really incredibly well. If you're OPEC, you've done a good job in the last 5 years. I mean, this market has thrown a lot at you, starting with COVID 5 years ago. This month, I think, is when we were beginning to talk about that. So it makes it difficult for them. But I think equally the OPEC, and if you listen to the energy minister in Saudi, he says they are pragmatic, not dogmatic. And I think we should listen to what he says, because that oil isn't going to come back if there is an Iranian peace. But Iranian peace may not be the most likely event. You may find that pressure on Iran puts Iran back into a corner, and then we need to be careful. Because I don't think Iranian peace comes easily. I don't think it's a matter of, the US administration wants it and therefore gets it. I think you're risking that it gets worse before it gets better. And the other way of looking at that is if there's pressure on the Iranian oil, what does that do? Do the Saudis and OPEC Plus, in fact, replace the diminished amount of Iranian oil, or do they not, and they take advantage of the likely higher prices that would result if you had an Iranian negative consequence?
So Iran really is the key factor for OPEC Plus in terms of their calculations as they look to whether or not they can add additional barrels. We know they're pushing past April at this point.
They'll look at all the economic data. They'll look at the price set, of course, and I know they say that they don't, but it is an important factor. But I think they will be pragmatic about the approach they need to take. So Iran is the outlier, I would say. But don't forget, we haven't solved China and the US. I mean, there's lots of noise around Mexico and Canada and tariffs and what about Europe and, solve the war and do a deal in Ukraine on minerals and metals. And this morning there was, a copper headline about, we're going to take a look at copper, which is important. But you haven't solved the issue of China and the US. And we don't know how that plays out. And I still don't know how Iran plays out. So I think those are the two to watch.
I'm sure we'll come back to the copper story, but I want to pick you up on Russia because if you have Donald Trump cozying up to Vladimir Putin, there is the question of whether Russian commodities are going to come back to the global market, if Trump is going to end the war, whether Europe and the US would start buying that Russian oil again. Do you think they will?
Well, they may have different paths to the US and Europe. So, the market is now assuming that the energy comes back. But when we say come back, the oil isn't coming back. The oil is already moving. Gas is the one that's interesting. So TTF has fallen in the last 11 or 12 days from, I think, 58 euros to, I think it was 44 euros last night. That's on the assumption that peace equals gas flow. I'm not so sure that peace immediately equals Europe taking incremental or large volumes of European gas. The oil, as I said, continues to flow. Now, Europe, in my opinion, is probably going to be slower to take the oil back, right? But America, we shouldn't forget, was taking both feedstocks and finished products into its markets prior to the war. Things like VGO were flowing, there was distillates flowing. You might have the slightly geographically ironic situation where America is taking Russian oil before the Europeans do in a large-scale way because of the political attitude towards it.
So you're basically saying that the sanctions aren't working because there are so many loopholes that actually, if there's peace...
Look, there's a price cap. So the price cap was reducing the income, and it made it very inefficient. I mean, some of the biggest winners out of this inefficiency were, in fact, the ship owners. So freight rates in 22, 23 and 24 were extremely high, but the market has healed itself. Freight rates are actually quite depressed at the moment, and the outlook is okay at best. Now, freight can spike very quickly when we have another disruption, but the oil market has a very healthy way of healing itself through disruption. So, yes, the price will spike, yes, freight will go up, but there's a calmness around it now, and the energy continues to flow. So I won't say that they didn't work. I mean, they were incredibly complicated, and a vast amount of effort has been spent on compliance and following the rules and understanding the rules. But the fact remains, very little Russian oil didn't flow to the energy markets around the world. It just went far further on this shadow fleet of vessels, and that shadow fleet is now around 1,000 vessels, which is the shadow fleet being those vessels that will take Iranian, Venezuelan, and Russian oil, probably a bit close to the line on some of the rules at times, but that's 15 or 16% of the global tanker fleet. So, we split the world into two on tankers.
Yeah, and that friction is there, and the diversions are there, and a lot of that oil and gas as well going to the Chinese market, which brings me back to what assumptions you're making about demand out of China through the rest of this year.
Well, China, it's no secret it's being soft, and everybody keeps coming back to the housing market. I mean, China is trying very hard. Our opinion has been that they're keeping an amount of, let's say, stimulus in reserve in case it doesn't go well with the Americans, and I still maintain that's the case. You've seen a lot of small actions by the Chinese to try and improve their economy, but no big bang stimulus package. I think there's a wait-and-see approach from China about how does it actually play out with the Americans, because there's some big paths here. You can end up in some sort of trade war between China and the US that goes poorly, but you can also end up with a deal, and we all know President Trump quite likes a deal, so, it can be a big fork in the road, and I don't think any of us really know the answer to that. So I suspect, or from discussions with some of the Chinese, many of whom are here in London during International Energy Week this week, that there is a sort of a quiet calmness, waiting and seeing how it plays out, but there is some support from the government behind if it does go badly.
Ben, you talk about the United States and Donald Trump liking a deal. Domestically speaking, he's kind of been on two minds of this. On the one hand, he's really cracked down, and not just him, his predecessor Joe Biden as well, on kind of the investigations in commodity players on things like bribery, on corruption, et cetera. But on the other time, he's kind of also advocating for consolidation in, say, the shale industry. How does that affect the flows that you're seeing out of the States?
I think the U.S. producer, I mean, there was a couple of things. There was talk of $45 oil at one point. I think that's highly unlikely. There was talk about 3 million barrels a day of incremental production out of the U.S. I also think that's highly unlikely. But, you know, I think these are playing to perhaps his constituency, which is fair enough. At the end of the day, he's a politician. The trade flows won't change that much. The American producer, and there has been consolidation, as you mentioned, largely into the majors' hands and bigger companies' hands, is a very rational economic actor in this market. And I think some of the conversations that perhaps the new administration has had with those producers is that they will produce in a rationally economic way. And I think you mentioned before I came on, you know, TI is just below $70 now. It's an acceptable number for most producers, but that's not one when you're sending out extra drill rigs and, you know, drill baby drill, is it? I don't think it's that kind of price set that you have. So I think they'll be driven by price. I don't think there'll be much growth in the US shale patch this year. Small, several 100,000 barrels a day of growth, which is not nothing, by the way, but it's not the good old days of the cycle upwards of American energy growth. So I don't think we should mix politics with American oil industry too much. So as much as they may talk a lot, they are very, very rational, and they're very good at what they do. But they are driven by price, and they're driven by what their shareholders want. And I would say the shareholders still want share buybacks at the moment, rather than incremental production, which I think would be negative for their share prices.
We're certainly going to hear from BP later today about what that strategy update looks like. We'll see if that playbook is quite similar. I want to come back to the deregulation agenda, basically, out of the United States. I can appreciate the political kind of separation from what's going on in the economics. It's a little bit of a different story in the likes of Switzerland, for example, where they are also going tough on some of these investigations. We know that one of your colleagues, Mike Wainwright, had a corruption conviction earlier, I think, at the end of last month as well. Can you give us an update on how Trafigura is thinking about that? Is there an appeal in the works?
Yeah, look, I can't comment on an appeal. I think the process that occurs in Switzerland is that you receive the report from the judges that are involved, and then you make the determination whether to appeal, and that will be a choice for the board of our company and a choice for the individual. I mean, I think it goes without saying that we were a bit disappointed with the outcome of that specific case, but it's hard to comment further on that. Look, the company is a very different company. You're talking about events that occurred some 15 plus years ago. We have a new CEO, Richard Holtham, who's recently just joined, a guy from the Gas and Power Division. He's pushing very hard for change in the company as well, or has been pushing for quite a long time. So, look, it's a different place. It's past events and one where we're very much trying to move forward from.
Talk to us a little bit about the BP story as well, because you kind of hinted at it there before talking about Switzerland. What are you expecting from BP today? I imagine you work very closely together. What would be the turnaround?
We say work closely. I spent 10 years at BP before I joined Trafigura. It's a company that was very good to me, very good to me. So I wish them the best, but I think they lost their way a little bit. I think the shareholders or the share price would suggest that's fair. I think Murray is going to come out today with some changes. Whether it's enough to placate the market, I don't know. They've got Elliott involved with them now. I think the Elliots of the world definitely have a role to play, and I think many times they come with some sensible suggestions. So, look, I don't know what BP's going to do. I wish them the best, and some of my ex-colleagues are still there, but I think they probably needed a change of strategy, and maybe Elliott is a force for the good in that company.
All right.
Ben, just briefly, does the unwind of these renewable assets that we're seeing from energy majors continue?
Well, look, I think it's likely, yes. I mean, you've got to remember, a lot of money's been spent and not a lot of money has been made.
Okay.
There's a limit to how much your shareholder will accept that kind of investment, I think.
Ben, thank you very much indeed. Great insights. Ben Luckock, Global Head of Oil at Trafigura. Coming up, we stay on the energy space, a different part of it, though. E.ON shares gain as the German utility boosts its outlook for the year. We're going to speak to the CEO. That's coming up. Stay with us. This is Bloomberg.
The
This is the opening trade. We're 30 minutes into today's session, and you are seeing outperformance on the DAX. Green across the screen for European equities. You're also seeing the miners jumping this morning on this jump on copper, on the news of a potential US probe into copper tariffs. But we're also having lots of earnings news to digest this morning, Tom.
Yep, E.ON coming through for a beat and increasing its capex as well. Part of that's down to the AI story. The stock is up more than 2% so far in the session. As you can see, 2.6%. The energy giant, of course, based in Germany. Grids in focus, the grid operators as well, in terms of what the expectations are. So reporting it will ramp up investments up 15% this year as it seeks to profit from that energy transition and demand for connections from those AI data centres. Let's bring in the CEO right now for a reaction to the earnings story, Leo Birnbaum. Leo, thanks for joining us. Your reaction to the earnings, what the investment around CapEx tells us, how much confidence you have in this AI story going forward.
Yeah, good morning. Thanks for having me. First, the confidence that we have in our investment plan is not only driven by the AI story, that's a supportive fact, but we actually have a number of fundamental drivers which are driving the need for more infrastructure. One is the continued expansion of renewables. The second one is the continued addition of other users like batteries, battery factories, etc. And then data centers just come on top. So all in all together, like the need is increasing. And so this is why we are also having the opportunity to increase our growth investments up this year, 24 versus 23, up from 6.5 to 7.5. And as you just showed, going up another more than one more billion, 8.6 billion this year. So 2.1 billion increase in 2 years. This is what we are really talking. And we are talking about a tripling over the last 5 years.
Leo, some of your competitors are rethinking their renewable assets. Is there any caution at all from you and the firm around how far and how fast you want to go in terms of building out your renewable footprint?
Yeah, we are not on the renewable side. As E.ON, we have some renewable activities, but they are negligible in the overall scheme. If you're looking at our investments, they're mostly driven by the need for infrastructure. And that need for infrastructure is pretty robust. If renewables targets would be adjusted slightly downwards, depending by technologies, it would have basically no impact on us whatsoever, because our growth aspirations are still below the needs that are driven by the political desires. So in that sense, our growth story is intact. I think on the renewable side, we need to see which renewables can we add that really add value to the system and not only cost to the customers. But adjustments there don't hit us.
Well, in terms of those political desires, Leo, and good morning, it's Lizzie here. I know that previously you've expressed frustration at the interventionist approach of the Scholz government. Now that we've had the election, I wonder how you want Friedrich Merz to operate. Do you expect a turnaround in energy policy now?
I think we are going to see an energy policy which is driven much more by the need to improve competitiveness and affordability. In that sense, the new German government will probably talk the same line as the new EU Commission has already said. Also, the EU Commission is now driving towards a more balanced approach in terms of competitiveness and sustainability. And we think that's a positive for the energy transition, because this focus, this balance, this thinking about trade-offs between affordability and sustainability makes the energy transition more affordable and therefore more sustainable. Actually, what's good for the customers in the end is also good for the energy transition. The biggest danger for an energy transition would have been just to continue as we did in the past, but we really need an energy transition update.
Well, is there any merit to reopening E.ON's nuclear plants in order to reduce Germany's power prices in the near term?
I knew that this question would be coming, but the answer is no. It makes no sense for private investors to think about nuclear investments in Germany.
Leo, it's Kriti in London. Talk to us a little bit about perhaps the dependency, the energy and the electricity dependency on other parts from Germany, on other parts of Europe, the likes of Norway, France, et cetera. This has become a key point of contention in politics around, outside of Germany. How does investment and security from a company like yourself prepare or diminish that burden?
I think what we are doing by investing into infrastructure is in the overall scheme making Europe more resilient. And I would caution everybody who thinks about national markets. In the energies field, we really have to think about the European market. Eastern Europe can only have a resilient energy system by being part of a European energy market. Same is true for Germany, but actually also for France. We have seen in the last years each country being dependent on other topics. You know, like we have been depending in Germany on gas import infrastructure from Belgium and France. France has been depending on imports from Germany in 2022. So I would say let's build a resilient European system. And for that, we need infrastructure, and infrastructure is our business. Therefore, that's the one reason why our case is actually robust, even in these difficult times.
So the argument against that, against some sort of kind of international grid, basically, that shares a lot of these kind of consumption abilities, is the security measures, especially in the context of what we've seen in not only the Scandinavian markets, but the Baltics as well, have just recently come off of the Russian grid. How do you prepare for the threats on things like cybersecurity, infrastructure, et cetera? What does the security conversation look like around that investment?
Yeah, I mean, let's just take the example of the Baltics that you just mentioned. For the Baltics, becoming part of the European market rather than being synchronized with Russia was an absolute necessary step to have an independent, resilient energy system. And one key to that is the connection that they have to Finland from Estonia and from Lithuania to Sweden. Now, obviously, these cable connections were attacked, but this just shows how important infrastructure is. And the Baltics just show how important Europe is. If you're not part of Europe, if you're just your own isolated national market, then you're much more vulnerable than being part of Europe. Cyber is a special topic because in any case, whether you build a national or European system, the system will need to be completely digitized. Digitized systems obviously are prone to be attacked by cyber. Therefore, we need to prepare for that. It's clear the hybrid warfare, the hybrid attacks on us by whichever players will continue in the future, we need to build for that.
Well, that argument then almost sounds like a reason not to maybe combine the ideas of infrastructure and the likes of AI, for example, if you do have that cybersecurity threat. Leo, that's a trend we've seen especially grow in the United States, that interdependence between the two. Is that perhaps a reason not to combine those two sectors?
It's no choice, actually. We will need to use every technology which we have, and AI will be one of the technologies which we will need to make the system more resilient, more affordable going forward. I could also turn it the other way around. Certainly, the bad guys will use AI to attack us. We will probably need to use every technology at our hands to defend us. So in that sense, I'm just afraid that is not an option. Digital, AI, every technology, every innovation that we can actually get, we will need to use in our systems.
OK, Leo, before we get to the future, at least the near future, the here and now of grid returns in Germany, does the next government allow you to increase those returns?
I think there's a good understanding that the investments that I just alluded to, which are necessary, can only be made if we can mobilize private capital, and private capital we can only mobilize if we can offer a sustainable return, which is competitive in the international context. I think that understanding is there. We are talking about a period starting in 2029, and therefore I'm actually pretty optimistic that we will see that. The next government will have enough challenges to find financing for all the other activities. They should be happy that in our case, for infrastructure, there is no need for state money as long as they allow private capital to be attracted. So I'm optimistic about that. And this is why we are continuing to invest until 2028. But to be very clear, to go up to the levels probably required, we need a different regulatory scheme starting 29.
OK, Leo Birnbaum, CEO of E.ON, we thank you for joining us and sharing your views with us this morning. That increased investment boosting the share price. E.ON shares up more than 3% this morning. And we're going to switch to another company that's reported this morning next, Danone. The shares hitting a 5-year high on the back of their latest earnings results. So we'll bring you an exclusive interview with the Danone CFO coming up next. This is Bloomberg.
Welcome back to the opening trade. We're about 43 minutes into today's session, and the heat is not letting up. We're green across the screen in several of these markets. Stoxx Europe, again, very, very high this morning, higher by about 0.5%. But the outperformer continues to be those German markets. The DAX higher by about 0.8%. But even the FTSE 100 and the CAC 40 on board as well. We'll see whether these gains continue in the rest of the session, but 43 minutes in, things are looking good, Lizzy.
Yeah, they are, including for Danone, and those shares are up 0.9%, having recorded their earnings this morning. We can get to an exclusive conversation now. Off the back of these results, the Volvic maker reporting actually that they have posted resilient sales growth, helped by higher volumes, especially in North America. And we can speak now to the CFO and Deputy CEO, Jürgen Esser. Really good to have you with us, Jürgen. Thanks for being here. I note that you have actually only forecast like-for-like sales growth of between 3 and 5% for 2025. So it's been resilient up to now. Why so cautious ahead?
Good morning from Paris, and thank you for having me. First of all, we are very, very happy with the results of the last quarter of 2024, growing plus 4.7%, but also with the full year of 2024, where we have been delivering on all the financial metrics. And if I can humbly say, I believe it shows one thing, which is that our company, Danone, is back. And I'm saying Danone is back because we are demonstrating again that the portfolio, which is focused around health, about health and nutrition, is delivering superior results. 90% of our volumes sold are eligible for daily consumption. That's a measure you will not find anywhere else in our industry, and it shows that this is driving growth. And to be very concrete, you see, for example, in the US, one of our key growth markets, that Oikos Pro, the yogurt with high protein, low fat, low sugar, is flying off the shelf. You see that our medical nutrition is growing quarter by quarter in double digits. So having a strategy which is focused on health and nutrition works very well for us. Strong results. Actually, we have been closing, as of today, the first chapter of our strategy, which is called Renew Danone, and we are going with confidence into the next chapter. And we believe that the 3 to 5% guidance is a good guidance and makes that we can deliver above our industry and the sector.
OK, so across those many categories, I wonder, are there certain categories that you expect to come under pricing pressure in the year ahead?
So the reality is that we are more and more focusing our portfolio on the value-added part, on where we have truly a differentiated portfolio, and this is working very well for us. When you look in the US, our portfolio is very much skewed towards yogurt, very much skewed towards Greek yogurt, and especially high pro. This is growing extremely fast, and it also enables us to take the necessary pricing depending on the level of inflation we will be exposed to in 2025.
Jürgen, do you expand your portfolio? Do you look to add with acquisitions?
Yeah, look, I mean, I think that we have, over the last 3 years, regained a lot of credibility because we have delivering quarter by quarter for 3 years. We have been deleveraging quite a lot our balance sheet. We are now at the lower end of the corridor which we are looking for. And yes, we have been very clear that we want to look for meaningful acquisitions. And what we mean with that is to look for acquisitions which complement our portfolio within our categories, in the adjacencies of our categories. We have seen us buying a few smaller companies. For example, in home care, we are eyeing a company actually in the US which is selling kefir. So this is the kind of acquisitions we are looking at, staying financially disciplined, of course. But today, I think we are in a position of strength, and this is what we want to leverage.
OK, so you're ready to pull the trigger on more acquisitions. Talk to us about how you and the team judge what is a fad and what is sustained. Kefir versus oat milk. Is oat milk a fad?
I think, you know, what is really great? What is really great is that we are the largest flexitarian company in the world. We are offering both dairy nutrition, so great yogurts, great kefir, we are offering skyr, we are offering all the range you can think about in the modern dairy shelf. And at the same moment, we are offering what you were saying, which is an oat milk, which is an almond milk, which is yogurt ranges on plant-based, which is even cheese. And so we let the consumer choose. And so we believe that we're here at the sweet spot where we can answer and address all the consumer needs. When you look at our silk portfolio in the US particularly, we are now very clear on how we want the consumer to use our product. We have, I believe, the best oat milk for enriching your coffee. We have the best almond milk to enrich your cereals. And so we are feeling very bullish about the totality of the portfolio because we can address all those needs of the consumer in the morning during breakfast, but also during all the day of snacking and consumption.
Well, Jürgen, you've given us quite the sales pitch there, but you did mention silk, and I'm curious about that simply because you had a big improvement of Alpro in Europe as well. You talked about the silk portfolio in the United States. What lessons do you transfer over?
Yeah, I believe you need to be very clear where you are differentiating versus competition. And what works for us very well in Europe with the Alpro brand is the fact that we are very clear on the occasions. It's what I just said before. We have the best oat milk for barista usage within your cappuccino. That's great. We have the best almond milk to go in the morning with your cereals. But then you need to be present where the consumer is. And this means to be present in coffee chains around the world. That needs to be present in away from home locations in order to make your brand visible and come with meaningful innovations. For example, we have just been launching a kids range under the Silk brand in the US to be targeting more this very interesting consumer group, and we believe this is going to work. So we are quite bullish actually about the totality of the portfolio, about what we call essential dairy and plant-based.
Yeah. Well, Jürgen, you talked a lot about the United States. Let's zero in there as well, because there are two main themes coming out of the States right now. And that, of course, is one, on the one hand, the weight loss story from the likes of Ozempic as well. On the other hand, it's the tariff story. And I'm curious if almost maybe both are going to be affecting your stock price. When we get tariff headlines, Danone certainly reacts. How do you prepare for that? Does that affect your pricing strategy? And just walk us through your strategy around the U.S. tariff threat and, of course, the rise of weight loss drugs as well.
Yeah, first of all, when you're taking care of your health, when you're taking care of your well-being, and also when you are under GLP-1 medication, what you need is high-quality protein. What you don't need is high level of calories or fat or sugar or salt. And this is actually what we are offering to the consumer in the US. And this is why ranges like Oikos Pro, but also our more traditional Greek range, is going from strength to strength. And so I think we have here a portfolio which is extremely well positioned in the US. Depending on to who you talk, today the penetration of GLP-1 in households in the US is somewhere between 8 and 14%. And what we are seeing is the consumption of yogurt is 3 times vis-a-vis a household which is not using those kind of medications. So for us, if there's anything here, it's a huge opportunity. On the other side, on tariffs, it's of course an important topic for us. We are a global company, so we are not immune on this topic. But the reality is that between 80 and 90% of what we are producing is actually what we are selling is produced actually locally. So take the US, we are sourcing from local farmers. We are sourcing from local farmers our milk. We are sourcing from local farmers our vegetable and ingredients. And we are producing in the US and we are selling in the US. So in that sense, we are a little bit less exposed to those discussions. And that's for us definitely a benefit.
All right, Danone CFO and Deputy CEO Jürgen Esser joining the program this morning to talk a little bit about everything. We thank you so much for your time. He ended there talking a little bit about that tariff risk and that geopolitical risk as well. It's not only impacting the likes of Danone as well as other consumer brands here in Europe. It's affecting the fundraising environment in other parts of the market. Take private credit, for example. Firms now struggling to raise money at the level seen over the past couple of years. Bloomberg has now a new newsletter. It's a hard word to say. Their new newsletter called Going Private, covering the private markets and the forces moving capital away from the public eye. Geopolitics, very much one of them. At the helm of that project, Silas Brown joins us around the table for more. We just heard there from the Danone CEO talking about how the geopolitics basically factors into kind of their business strategy. How does that show up in the fundraising environment that you're seeing in the likes of private credit, given that it's coming off such a massive boom?
Yeah, I think it's an exciting time to be alive for the larger private credit firms. And with the expansion of private credit and private markets more broadly, I think you'd be forgiven for thinking that the success and the growth is shared kind of equally across the street. I don't think that's true. in fact, the largest firms are the ones who are enjoying the spoils of the growth. And we reported this week about HPS raising 10 billion, at least 10 billion from investors for a new junior financing fund. Earlier this last month, we reported that Ares had raised a 30 billion pool of capital for European direct lending. This is alongside, in a kind of Tale of Two Cities style thing, of other funds that I won't name, struggling to even maintain the level that they reached a few years ago.
Go on, Silas, give us the list. Okay. So there's bifurcation. What about those in the middle?
I think there's a starved middle, clearly, and I think part of the we've seen a lot of consolidation in the industry and a lot of the sort of middle class firms being snapped up by larger institutions, and I think one of the reasons, the motivations for the mid-tier firms to sell is a recognition that they need to attach themselves to a kind of like big firm that has big distribution networks, kind of envelop them into a broader, bigger ecosystem. And I think that is very important for scale in private markets.
All right, Silas Brown, thanks for bringing us a preview of that newsletter. Don't forget to check it out. The new Bloomberg newsletter, Going Private, goes live today. Sign up at bloomberg.com/private. Going Private. Bloomberg.com/going private. That is the new newsletter. We've also got plenty coming up on the docket today. US eco data, Fed speak, BOE speak, the BP Capital Markets Day. But I have to say, I think the highlight for the markets, Tom, is going to be the Nvidia earnings.
Yeah, put all that to one side, because Nvidia is certainly in focus. Look, are they going to be seeing significant, still contained demand, or sustained demand, I should say, for the Blackwell chip? The movements are right from Hopper to Blackwell. Or do you get an air pocket where their customers hold fire? There was that analyst report around Microsoft maybe scaling back some of its investments around data centres. That really has kind of exaggerated, to some extent, the concerns around whether or not that sustained picture is going to come through. We have had, Wedbush analyst Dan Ives saying he's pretty confident they're going to come through with some gangbuster results.
The Uber
from
bull, Dan Ives.
The Uber bull, exactly. When has he not been bullish on this stock? But look, this is the one for the markets. This is today. Any comments from Jensen Huang as well on the additional risk from the Trump administration around raising the bar on which chips they can sell into the Chinese market?
And of course, this is the first report since DeepSeek and the DeepSeek rout. Do you think that those words will be coming out of Jensen Huang's mouth? DeepSeek? He's
going to get asked about them, right? And the answer probably is that you're going to get greater adoption of this AI technology. It's going to be more quickly dispersed, and therefore it's going to be good for the industry. It's probably something along the lines with which Jensen Huang is going to answer that question. But you're right, DeepSeek is also going to be part of the narrative when analysts are scrutinising the results later today.
But I imagine the sanctions and the export controls are going to be there as well. And in the last couple of days, we've gotten so many headlines, you've covered this quite heavily, around the pressure Donald Trump may be putting on likes of the Netherlands, on Japan, etc. Nvidia came right out of the gate talking about creating one product for the U.S. and one product from China and then one product for the rest of the world. Yeah. Is that still the strategy?
The H20 is the chip that they can supply into the Chinese market. It's the chip that is being stockpiled right now by the likes of Alibaba and Baidu and DeepSeek, according to reports. Is that chip in the lens of those in Washington and the Trump administration for the next chip that is restricted from that market? Jensen Huang gave a tongue lashing to Biden. Is he going to be constrained when it comes to the Trump administration? He was very critical of the policy measures of the Biden administration. Is he going to be restrained when it comes to Trump, or be measured and equal and balanced in terms of how he responds to that?
Certainly a conversation to be a fly on the wall in those conversations in the Mar-a-Lago state. We thank you for that context. I mean, this is going to be crucial. You're seeing the tech stocks already flying ahead of that report as well. Futures, right, the equity, as I say, also very much in the green. That does it for the opening trade. The Pulse is up next. This is Bloomberg.